Today's Talk About It Tuesday question is, some people are saying that buying stock in the SpaceX IPO is the opportunity of a lifetime, while others are saying it's a terrible investment. What are your thoughts on it? Well, I have a general policy of not giving stock recommendations, and I'm going to stick to that. But I'm going to give you some serious food for thought so you can make your own decision from a more knowledgeable place and possibly use this to make decisions on other things in the future. So, first of all, an IPO is an initial public offering, which means it's first time out there being publicly traded. So SpaceX is a company that we know is being led and pushed by Elon Musk, and they have three primary levers of income, which is space launch, satellite internet, and AI, which is Grok. So as of this video, the stock is trading at $201.25 per share. And that means if you buy it, you're buying one share, one piece of ownership in this company at $201 per share. There are 555.6 million shares of this company. So there are 555.6 million shares. Each share, right, currently is valued or being sold at, being sold at $201.25 a share. So why is that relevant? Okay, Elon Musk gave a valuation of the company, said this company is worth $2 trillion. When he put it out there, he said this company is a $2 trillion company. And he said that by 2030, it will be making $1 trillion per year. By 2030, that's 4 years from now, that it will be making $1 trillion per year. That drove a lot of people to say, wow, this is a phenomenal company. It's valued at $2 trillion, and he says it's going to be making $1 trillion a year. But if we look at its revenue from last year and its net profit from last year, it tells a different story. So in 2025, its revenue was $18.67 billion, not trillion. 18 billion is a long way from 2 trillion or even from 1 trillion. But you're like, okay, it made $18 billion. But what about the profit? It had a net negative. Listen to what I'm saying. A loss. It had a net loss of $4.94 billion. So almost $5 billion. In 2025, it lost almost $5 billion. But he said the company's worth $2 trillion and promises from a loss of $5 billion in 2025 to $1 trillion gain or $1 trillion at least in revenue in 2030. Let's suppose that's true, that it lost $5 billion last year, but it's going to make $1 trillion within the next 4 years. I said today, as of this video, is trading at $201.25. And I said there are 555.6 million shares. So that means if you multiply 201.25 times 555.6, that means you're paying as if the company was valued at, I had to write this number down, it's so big, $111,814,500,000. Let's do the math. 201.25 times 555.6, $111,814,500,000 is what the company would have to be worth to justify the price that they're selling per share. Now, I don't know what kind of math you do. Of course, we know that you pay for projection in the future when you buy stock. But for a good growth stock, right? Because we have value stocks, growth stocks. Growth stocks are usually these tech companies that have a promise of making major, revenues in the future. As an investor, a good price would be no more than 25 times the current earnings. A PE ratio, we call it price to earnings ratio, no more than a PE ratio of 25. This doesn't even have a PE ratio because it had no earnings. It had had a negative loss, it lost almost $5 billion, but it's trading as if the company is worth $111.8 trillion. I don't know. You do the math. But some of you think, well, Elon Musk made the promise. It must be true. So let's just look at some of Elon Musk's most recent business ventures. So we know he bought Twitter and turned it to X. Twitter is no longer a publicly traded company, so we don't know the exact numbers in terms of profits and losses, but they reported net losses for last year. So X is not profitable. X is net negative. Let's look at Tesla, because some of you say, well, what about Tesla? Okay, what about Tesla? Tesla promised that we'd be having self-driving cars by now. It hasn't happened. But okay, so it hasn't happened. Let's look at Tesla in 2025 made a 3.8 billion profit, which is down 46% from the year before. So trending negative, only $3.8 billion. And you say, okay, but so what? So what? As of this video, one share of Tesla is $406.64 per share. I said a PE ratio for a good growth company, a solid price, the PE ratio is 25. The PE ratio for Tesla is 371.5, meaning you're paying 371 times its earnings. The price you're paying is 371 times its earnings. You cannot make that up in a lifetime. So when you think of shares and paying a price, you got to think of the total. Would you pay 371 times what a company is worth if you could buy the whole thing? Let's go back to SpaceX. If somebody told you my company lost money last year, but I'm saying it's still worth, even though it lost money, it means it's negative, right? It's below zero. I say my company's worth $2 trillion. Even if you believe that, would you pay then $111 trillion for a company they said is worth $2 trillion, that their financial records show that it's not even worth that? It lost money the year before? You do the math. I don't know. The math is not mathing to me. So I, again, will not make any recommendations one way or another. But I say, look at the math. Look at the track record of the person who's pushing it. You do the math and put it all together. And there are other things. So I generally tell people, 99% of people shouldn't be buying individual stocks, period. Because you don't know how to evaluate a company. You don't know how to look at their financials. You don't know how to look at the management and the people who are running it. You don't know how to look at the trends, technological trends and competition. You don't know how to look at so many factors that will influence whether or not the company is profitable or remains profitable in the long term. So you're better off buying companies that are already profitable inside of an index fund, inside of an ETF, inside of something that you don't have to think about, where it has a history of being profitable. It passively changes because the S&P 500 is going to be the S&P 500, meaning one company falls out, another one comes in. An index fund is an index fund. You're still going to have the top 500 companies. Most people shouldn't even bother. It takes a lot to be able to understand fundamental analysis of a company. But you definitely shouldn't be doing it because of the personality behind it. You definitely shouldn't be doing it because the technology just sounds great. You definitely shouldn't be doing it because you want to take a gamble, make a bet on the next big thing. Those are horrible reasons to make an investment. And so I'm going to leave it there. But I think you can do the math, and either you're going to buy it or you're not. Either you believe in it or you don't, but the numbers don't lie. So I'd love to hear your thoughts on it. But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.